In this episode of Smart Humans, we talk with Louisa Klouda, who's the CEO and founder of Fenchurch Legal. We discuss the world of litigation finance. What is it? How can you get involved? What are the opportunities to make money in big cases or in small cases? We discuss where the global economy is headed from somebody living in the UK. And of course, we have the predictions for 3 years out.
Welcome to Smart Humans with Slava Rubin, presented by Vincent. In this alt investing podcast, Slava talks to amazing minds about their investment journey and finds out what it takes to make it in the markets. And now, here's your host and smart human, Slava Rubin.
I am excited to tell you all about Air Insider, the private market investor's unfair advantage. Every week, you get public and private market investment picks from industry experts like Jason Calacanis, Anthony Scaramucci, and of course me. You'll get access to exclusive monthly briefings as well. Right now, we are offering the first year at 50% off, which is less than $10 per month. We've also partnered with some of the best investment platforms and tools and gotten our members thousands of dollars of offers and discounts. This includes $50 off of free stock from Public, up to $250 of free investment credit from Percent, and up to $1,000 of free gold from Argo, and a whole lot more. All of this for just under $10 per month. You can sign up at withvincent.com/insider. Again, that's withvincent.com/insider. Invest like an insider. Hello, and welcome to the latest episode of Smart Humans. Very excited for today's guest. We have a topic that we don't typically talk about, which is litigation finance. And we have one of the experts in the world, which is amazing, Louisa Klouda, who's CEO of Fenchurch Legal. Welcome, Louisa.
Hi, Slava. Thank you very much. Great to be here today.
Absolutely. So obviously, we're going to want to dive into this new asset class, but first we need to get to know you. So where did this all start? Let's go back to your childhood, whether it's your schooling, whether it's work. How did you get into the world of alternative assets as a whole?
Straight after university, believe it or not, I studied maths and economics in the UK and did an internship throughout my university. It was a kind of a prop trading firm. So we traded currencies and commodities, very fast paced. Throws you into the deep end of the investment world, but it definitely wasn't for me. That's what it taught me. And I think I was definitely more drawn to longer term research led investment strategies rather than real-time trading, sorry. So I moved down to London after university, and my first job was in a boutique wealth management and corporate finance firm. And one of the things they were quite big on was structured debt, and they provided that on behalf of SMEs. So that's where I kind of got my first exposure to private credit, if you like. And I really loved the strategic side of it, looking at the risk and structuring deals and raising capital for them. So that's how I kind of got into the private credit space. And whilst doing a lot of capital raising and raising debt and structuring debt for those type of clients, I discovered litigation finance. So I saw a huge potential in the market. I did a lot of research, and what I kind of found is that a lot of funders were doing it in a very risky equity style way. So what I wanted to try and do is take my kind of secured lending and private credit structured debt experience, if you like, and apply it to the kind of litigation finance world. And that's how I ended up founding Fenchurch Legal. And the idea behind it is applying the secured lending kind of model to high volume consumer claims.
Amazing. And how long was it from ending university to starting your company?
5 years. So pretty fast.
Yeah, that's pretty fast. What is it, do you think, in your background or your childhood led you to be so entrepreneurial so quickly?
Oh, I definitely come from a family of entrepreneurs, but I think it was university and part become part of the investment society that didn't exist. That there was actually a finance society in the university, and there wasn't an investment society, so that it was very kind of accounting based. And there was two or three of us that really, like from a young age, wanted to start investing, and we thought we'd form an investment society at university, which we did. And that's how we got into the kind of internships that we all went down to London to do, and just started investing. And I think off the back of investing ourselves into other people's companies, we got attracted to setting up our own businesses. And there's about 3 or 4 of us in that group that all have our own businesses now. So it's definitely investing turned us into entrepreneurs.
Amazing. That sounds like a good cohort. And when you're saying investing, were you doing like angel investing or startup investing, or was it similar type of private credit type investing?
No, but back at university, it was stock market stuff. That's kind of
Oh,
what we
public
were
markets.
taught. What we yeah, public markets at the time. It's only kind of afterwards when we started, I guess, getting a bit more educated, that we started looking at the more private side of stuff. I don't think you really get taught about private placements and investing when you're younger, but going into industry, I think you get exposure to things that not many people in the kind of real world investing market get access to, which is why I think it's really important to educate people about alternatives, because it gives people access to investment products and companies that people don't otherwise know about.
I completely agree with you. That's such a good point. That's why we have this podcast, and it's awesome that we're able to have people like you to share that. I mean, we don't get taught when we're younger about these alternatives. It really is just about, a 60-40 allocation of 60 into the public markets, 40 into bonds, and 0 into privates or alternatives. So let's talk about you for a second, which obviously you have significant exposure for your net worth into your own company. So let's just put that aside. And how do you like to invest your own money? Obviously, again, separate from all the exposure that you have, which is probably significant to your own company. Do you have a 60-40 public markets, bonds, 0 alternatives? Or I'm guessing it's probably not that mix. It's some sort of other percentage between the three. What does that look like for you?
Yeah, definitely. I mean, my two principles are invest in what you understand. I don't like taking blind bets, and diversification is key. I think regardless of your risk tolerance, you want diversification. So I avoid things like that I don't understand, basically. So crypto, I hold a bit. It's speculative. It's a very small part of my portfolio, high risk, high reward, but I don't understand it. So it's going to always be a very small part of my portfolio. Same with industries that I don't understand or know a lot about, like healthcare industry. It's never been something kind of I've been interested in. I don't understand, so I'm not going to have high exposure there. The things that I do invest in, again, probably 60-40 in the opposite way. So I'd say 40% in public markets, split between low risk kind of index trackers or funds for which are there for kind of low to medium term risk, but for the long term that I don't really touch, and another 20% in more kind of stock picking, your typical public market stocks that I find like and kind of follow. And then the other 60 I'd say is split across alternatives, private businesses that I like to invest in. I love the early stage hustle and being part of the journey. So whether it's kind of businesses that I set up but other people operate, or businesses that I see I like and kind of want to put some money in, and property. I think it's something that everybody should have as part of their portfolio. Different
Which one was that?
jurisdictions.
Did you say Anthropic?
Property,
Oh,
properties.
property.
Property.
So what percentage of the 60% do you think is property?
Probably about 20-25.
So like a third of the 60. So you like startups, and then property, anything else? Meaning
Um,
in that
uh,
60%.
no, early stage businesses. So my alternatives are probably split across private businesses that I own or I'm like a kind of majority shareholder in, or other investments that I put in as a VC style investment.
How many other businesses are you like the owner of that it's kind of like your business that somebody else is running? It's a very interesting strategy.
Two as a majority, and then one that's currently being set up. It's very early stage, kind of legal tech firm that I'm going to be part of, but not majority.
So, I mean, you're a great example of the traditional 60/40 public markets to bonds is maybe not the contemporary portfolio for everybody. So that's why you're an awesome guest. Anything relating to art or collectibles, or is that just something you ignore?
Not really, no.
All right, perfect. So you have a really interesting background and obviously have a view into what's happening in the world. What do you think of today's market? And this is just like a massive general question. So, in terms of the stock market, the economy, geopolitical, inflation, jobs, where we're headed, what do you think the coming 3 to 12 months looks like? What's the trajectory of our global economy and what are the opportunities right now?
Yeah, well, volatility is probably the only word that can describe the recent years and upcoming years. I think we're seeing things in the markets that nobody can really explain or predict directly. I think that the long-term high interest rates and inflation have obviously like killed a lot of opportunities for people that expected out there, all the geopolitical risks, I think, massively across the world at the moment. But that also does come with a lot of opportunity. So I kind of see investors in my mind as two groups. You've got your active investors and your passive investors. The passive being just someone that's putting money into the S&P long term and knows that it's going to yield a good steady return over the long term, but don't look at it or expect anything in the short term. And then you've got the people that are in and out of the markets, whether that's public stocks or businesses, that the I guess general market conditions are going to affect the short term returns. And if you have the time and the knowledge, I guess, to put into understanding businesses or investing in businesses, you can put your money to work, get good returns, and compound your yields over the years.
So, if I had to put you on the spot, are you thinking that interest rates are going to be coming down in the coming quarters, or do you think they're going to be going up? Do you think inflation is going to stay flattish or go down, or do you think we're going to get back to some inflation numbers going up? Do you think we're going to get to like all-time highs in like U.S. or global economies, or do you think we're set for potential recession and we're going to have a little bit testing lows, etc.?
Yeah, I definitely think there's a recession looming, and it has been for a while now, unfortunately. I think if COVID hadn't happened, we would already be in it or already potentially coming out the other side of it. But I think that just kind of threw a spanner in the works that nobody obviously predicted, saw coming, or knew how to handle. I think since markets haven't stabilized, they've tried to and they've failed. But we've definitely got a recession looming, which is obviously not good for many reasons. But markets have to correct themselves. I think interest rates have to come down. I don't think they're sustainable at the rates that they are, and inflation needs to get under control. I don't think it's an easy fix as it has been previously, because of all the government debt and the I guess instability across the markets. But I guess that's what the governments are trying to achieve right now, and I hope they do.
Absolutely. So, is your prediction that interest rates a year from today, if we have you back on, are down? And if yes, how much do you think they're down?
At least 1%, I hope.
Meaning like 100 basis points.
Yeah, 100 basis points.
So that's like significantly nice. The inflation one is the tricky one, right? Because we want to get inflation down, but yeah, for various reasons, inflation still seems like it wants to, if not stay flat, potentially go up.
Yeah.
What's your thoughts on that? And you're a serial entrepreneur. Obviously, you're dealing with money and all kinds of like lending and such. How do you think about that as it relates to independent of your actual company, right, that you run? But how do you think about thinking about the interest rate and
Yeah, I
inflation?
mean, the interest rates across the world at the moment have massively impacted us as a business in the sense of return that we offer to our investors. Because a lot of people think it's not related, but if I'm offering fixed term returns at 10%, but the banks are offering 5%, then my opportunity isn't as attractive anymore. So it's definitely impacted us as a business. So naturally, we kind of have to price that into the world, into our investment opportunity, but then it's naturally priced across the world as well. People are saving at higher interest rates. People are not using their money, and we need them to use their money to ultimately bring inflation down. So I think the governments need to lower rates. They need to get the public spending again, but inflation at the rate that it is not sustainable. Like, people are not making end meet. People are not able to spend, invest, and the money in the economy is not flowing. And I think that's a systemic issue that needs to be, I guess, looked at the root of the problem. Bringing inflation under control, I think, is the key priority that we need to be looking at the moment.
All right, perfect. All right, let's get into litigation finance and Fenchurch Legal. What is litigation finance? Let's just start there. And what is it that your company does as part of that ecosystem?
So litigation finance, as a, I guess, more general topic and industry, the point of it is to fund the legal costs and disbursements of a legal case. You've got claimants that want to bring lawsuits to fruition. It's very costly and time consuming, and not every claimant has in order to, I guess, enable them the access to justice that they require, people like us come into play. The market is kind of split into two. You've got your large ticket, large scale lawsuits, the big fancy lawsuits that are spread across the news that most people hear about. And you've also got your small value consumer claims. Looking at the UK market for a moment. So those two sectors of the market are very different in the sense that the big cases are super, super expensive. They'll take years sometimes to complete, and the settlements, if won, are massive. On the other side of the market, you've got small claims that might take 9 to 12 months to settle, very small value, anything up to £10,000-15,000. And it's very much a process-driven claim. There's not much kind of, I guess, adverse risk to it. The big litigation side of things is an industry that is looked at by a lot of kind of equity style investors. So the typical people that will put in 5 million and expect a 3-4 time return back if there's a big settlement, because they tend to structure their returns as a percentage of the winnings when the actual case settles. The other side of the market, it's very much standard return. So you get your money back plus a return that's pre-agreed, regardless of whether the case settles or doesn't. They're the kind of two sides of the market out there at the moment. It's a massively evolving industry. It's quite new. It's not been around forever, growing. And yeah.
Yeah, so somebody did something wrong, supposedly, and then the other party wants to try to sue them to get compensated for the thing that went wrong. But for some reason, that other party might not have the money, right? Or have the appetite or the risk to want to do this. So they basically get somebody to help fund it, right? So it's kind of like people needed to find money to make a movie because they don't have the money themselves to invest in the movie. Instead, here, they're creating the lawsuit and then looking to generate the returns. The movie might flop and they might make no money. The lawsuit might go backwards, right? And they might not win. So they might not make any money. And if they do win, there could be a huge return, just like a big blockbuster movie hit sort of thing. Is that right?
Exactly. Yeah, very similar. Never thought of that an analogy before, but it is
Yeah, you're in
very
the movie
similar.
business. So yeah, I just wanted to simplify for our listeners. And where do you sit with Fenchurch Legal as part of, you said there's the big cases and then there's the small cases. Are you in one of those?
Yes, we only focus on the lower value consumer claims. So your typical consumer redress claims. You've got a huge number of consumers in the UK that are seeking compensation for a specific issue that's occurred. Taking financial mis-selling cases, for example, you've got big banks, or sorry, taking the mis-sold car finance agreements at the moment, which is a massive kind of industry in the UK that's blowing up, and it's the next big thing happening. motor car finance agreements that have been sold to the ending client, that bought a car. They got some form of credit from the bank via a broker. The brokers have taken massive commissions. They haven't told the clients about them. There's now basically a financial mis-selling claim due to the client for compensation because they've taken a credit facility on terms that they didn't really know who was getting paid what out of, and potentially have been financially impacted off the back of it. What happens with these type of claims is that 2, 3, 4 claims get processed. They go to court. Legal precedent is set, and then everything follows from that. So there's a very clear path on how it's done, who the defendants are, how it needs to be processed, how the compensation is calculated. So what we do is we back those type of cases en masse. We don't go out looking for cases left, right, and centre with claimants saying, "Oh, what case are you doing now? Let's have a look at the prospects." That's not what we do. That's not our area. That's still a very profitable area. It's not what we focus on. We focus on finding the high volume, low value consumer claims that are managed by kind of small to medium sized UK regulated law firms or specialized claims management companies. And we've structured our facilities in a way of kind of a secured lending, revolving credit facilities with them.
So there's been a case or four, as you say, or several, and now it's set the precedent. So now it's like a formula, which is if you have this situation, this was what went wrong, you paid this much too much, and because of that, you have this type of car with this type of lender, you deserve, this much money back. Is that the sort of thing?
Exactly. I mean, to get an idea of how the kind of lead generation of claimants occur is big adverts going, did you have a car finance
Issue.
agreement between this and this year with these lenders, etc. If you did and your car was worth more than £15,000, then you're eligible for a claim. They come to them, they qualify them, they go through a vetting procedure to see if they actually did have the car finance, and if so, the value of it. And then it's a process. It's all protocol based and process driven. It's not litigation really. Again, most cases settle pre or post issue. A very small percentage actually get fully litigated and go to trial. Whilst we use the word litigation because that's the kind of its full nature of it, it's more or less a process-driven claims handling procedure.
Got it. So at your company, how many of these standard types of things that you're just trying to find more clients for do you have? Is it just that one carb one, or is there like 11 that you're working on all at the same time?
Different types. Again, from a diversification point of view, you don't want all your eggs in one basket. So we do housing disrepair claims, which is basically social housing tenants suing the council for not taking care of the properties when they should. We've got Ministry of Defence hearing loss claims. We've got personal injury claims. Which are quite huge in the UK. So lots of different types of things. I think we've got 4 or 5 at the moment. We're actively looking at a few more. So sub 10, but not just one.
Got it. And can you give us perspective on the size or scope of your company? Like how many litigations have you done? How much money have you returned? How much client, like whatever kind of numbers you use to talk about your size?
Yeah, I think we've raised and deployed over 45 million now. We've been going for 5 years. We set up in early 2020. So raised and deployed over 45 million. That's been across about 16,000 claims. So our typical loan that we issue against the claim is about £3,000 to £4,000. So quite small value, as I mentioned, at very high volume. We've returned over 25 million to investors over the years with great returns. What I don't know if I mentioned earlier is that every case that we fund is insured. So as I mentioned with the kind of large ticket stuff, if you win, you win big, but if you lose everything, like that, there's no return. What we do is structure the loans with a standard return, regardless of success or not, because we kind of predict the success rates of these cases at mass rather than on a portfolio basis, rather than on a case by case basis. And we know that the percentage of success is above 80-90%. So that 10% that doesn't actually succeed is able to be paid back without causing financial loss to anyone in the parties. But what we do is get insurance on each of these cases. So there's a specific type of insurance for this industry. It's called after the event insurance, and it basically insures two things. It insures all the costs and disbursements that you spend on a case. So the law firm spends £5,000 paying for experts, court fees, premiums, etc. They can reclaim that back if the case actually fails. And it also insures adverse costs. So if it does actually go to trial and the other side wins, they are liable for their costs. So it also insures that. So that for that 10-15% that might actually not succeed, there's insurance in place to cover your principal capital, so you're never at loss.
So does that mean no matter what, I'm getting my money back, but I'm not guaranteed to get my positive interest back?
Yes, so the law firm, the way we structure our facilities is that the law firm is still liable to pay that interest back to you. That's not necessarily the case everywhere. We've done that, I guess, in exchange for a less return because we care about getting our money back and our interest back. So in most circumstances, you've priced that into the risk and you're always getting your return back in either situation.
So either, no matter if I win or lose, in my investment, I'm still getting my principal plus extra interest return?
Sure, yes.
Well, that sounds very good.
That's why we do it.
You almost, given the scale, it almost seems like you're an insurance company yourself, right? So I'm not saying that you're actually an insurance company because you have the after the event insurance behind you, but you're working not on one-off kind of risk assessments, but it's really working through the risk at the aggregate level. I mean, you're doing 3,000-4,000 cases a year, it seems like. So that's like significant. And it's really the standard bell curve that you're kind of trying to understand, how this is all going to play out, almost like an insurance company, like an actuary.
Yeah, that's exactly what we do. Underwriting risk on a daily basis is exactly what we do. I mean, our principles within the business is underwriting upfront and underwriting and monitoring on an ongoing basis. Like our work doesn't stop once we issue a loan. If you're a lender against property, you lend money, you get a valuation of the property, and then that's it. Unless the markets massively crash, your property valuation is not going to deviate by 20%, which you've probably lent against loan to value. So you're kind of always covered. But with what we do, our asset is the case. The progress of the case, the settlement of the case is what we need to monitor. So we underwrite the law firms up front to make sure that we like them as businesses. They're financially strong and they operate well, they've got experience, they've got track record. And once we issue the loans, we then monitor the cases and the progress of the law firm overall to make sure that they're operating them properly, they're pushing the progress of the case properly, and they're making the returns they need to ultimately pay us back.
Yeah, I just want to state something that might be obvious or not. You're not the actual lawyers doing 4,000 cases yourselves. Can you give us some perspectives to do that 4,000 cases a year? How many law firms are you working with or giving money to?
We work with about 6 at the moment, active. I think that the 15,000 cases is probably split about across 8 or 9 law firms rather than the 6 that we've got active at the moment. But to give you a bit of perspective, a law firm that's like medium size, that you've got about 50 to 60 people, can probably handle anything between 6,000 to 8,000 cases at a time.
Wow, that's awesome information. Is this available to me if I wanted to be an investor with you?
So the market typically has been institutional financed for years now because it's not something that many people know about. I mean, before I got involved in the industry, I had no clue what litigation finance is. So a very new evolving market that people are definitely getting into. What we've done here is structure an alternative investment offering for people that want to invest at lower values. So your typical ticket size on this type of investment is 5 million and above, which means that people like us can't invest like smaller values as part of our personal portfolio. So we've created a fixed term rate loan note offering. It's structured as an alternative investment where people can actually invest anything from £10,000 upwards in multiples of 1,000 for a set return.
Amazing. So £10,000 minimum. Is this for UK only, or can US investors involve, or global, or?
Yep. It's a global offering, and anyone that's considered a qualified investor, they need to understand what they're investing in, can participate in something like this.
What's a qualified investor? Is that the equivalent in the US as an accredited investor?
Accredited, yeah.
Yeah. Okay, great. So basically, like $1 million of net worth for like 250K salary, something like that.
Correct, and experience in alternative type of investments before.
So being selfish here on behalf of the listener. So if I myself want to give you, $25,000 tomorrow, I can invest that. Awesome. And what should be the kind of returns that I should expect, and what's my liquidity opportunity there, or what's the lockup, or how does that work? So let's just assume my 12K.
Yeah.
Walk me through. You're the best salesperson. You're the CEO founder. So sell me on my 12K. What can I expect?
So we've got three different offerings. We've got a 2-year or a 3-year product, and each of those 2 and 3-year products has an income or a growth option. So interest rates that we offer to investors range between 11 and 13%. So 11% for the lower fixed term and income option. So you've got your 2-year, if you fix your money for 2 years and require a quarterly interest payment, you'll get 11% per annum for 2 years, paid out quarterly, and then your money back at the end of the 2 years. Similarly, for the 3 years, you'd get 12%. If you wanted the 2-year fixed term product, but you didn't want any interest payments and you want all your capital returned at the end, you'll get 12%. And likewise on the 3-year product, if you wanted to lock in for 3 years and get all your interest paid at maturity at the end of the 3-year term, you'd get 13%. And that's all like net paid to you. So there's no fees, nothing else hidden. So 13% on the value of your money.
Amazing. So using round numbers instead of 25, so we don't have to do math. If it was a 100K investment, I'd be getting a quarterly payment on the 11% for the 2-year. I'd be getting a quarterly payment on that 100K, right? So what is that? $11,000 for the year. So it'd be like $2,750 per quarter, and I'd be getting that each quarter, and then I'd be getting my 100K at the end of the 2 years. Is that right?
At the end of the 2 years, yeah.
Or if I was willing to hold and not get that quarterly payment, I would get 100, and I get $12,000 per year. So I would get $124,000 in 2 years
at the end.
And that's after fees, after everything. I would just get that one payment. Okay.
Yeah.
Pretty clear. So let me ask you an obvious question. Since, why shouldn't I be doing this? What's the risk here? What's the potential that that's actually not going to happen? The defaults, this is going to turn into a 0, or this is going to turn into 88,000 instead of 100,000, 124. What's the potential of that? I mean, that's kind of the catch, right? It can't be perfect.
Yeah, of course. I think with any investment, there's obviously risk. We don't offer risk-free returns. That would be amazing. The risk is obviously us not performing as a business, or the end law firms underperforming. So we're here to manage that risk. So there's lots of risk. There's risks of the case failing. We put the insurance in place. There's risk of the case not progressing or going AWOL. We monitor the cases on a monthly basis. There's the risk of a law firm going under. We move those cases and take them elsewhere to make sure that they're looked after by another solicitor. Not an easy process. It happens. We have to have backups in place. If for any reason something was to happen to our business as an operator, there'd be administrators put in place that would recover people's money and ultimately get back their return. What we're doing is kind of a form of asset-backed lending. So there's always an asset there to secure people's money. So the worst thing that could happen is, I always say to people, is delay. If we are late on receiving the money, then we obviously price in a big margin. It's why we take people's money. There's obviously a big margin in between the two, and we reinvest our returns to ensure that the margin within the business is large enough that if there is any bad debt or delays, we can price those in. For the 5 years that we've been raising capital and deploying capital and taking money off investors and paying investors, we've never defaulted on a payment. We've got 100% track record so far.
I mean, you can't be better than 100%, so that's pretty good. Is there anything, are you thinking to go into these big cases, or are you just like, we know the systems, we want to do it at scale, we're going to stick to what we're good at, and that's where there's a lot of money to be made?
Yeah, we know what we do, we like it, we understand it, and it doesn't require a lot of legal underwriting. So we see ourselves as a finance company. I think you mentioned before, we're not a law firm. We don't employ hundreds of lawyers. We outsource the review of the case types that we look into, and we monitor the industry changes and the legal precedents and the kind of key cases out there with specialists in the industry. But we don't have 5 lawyers looking at cases all the time and legal opinions. So we'd have to structure our company totally different and set up a new department to do that. At the moment, we've got far higher demand for money from our current borrowers and pipeline borrowers than the money to deploy, which is why we're actively capital raising. So for the time being, as long as the demand's there, that's what we're going to stick with. If we decide to expand, we'd do so with a specialist team.
Awesome. And then is there anything else that you'd want to share with the listener about litigation finance, or, the pros or the cons of what we're discussing?
The only thing I wanted to mention on the investment side of things is that we actually take money in US dollars and euros as well. We as the company take the currency risk. So if somebody wanted to invest in dollars, they can without taking that currency risk. So I know that's quite an important factor for many investors cross-border that want to invest into the UK. I guess pros and cons on the market as a whole. The market's massively evolving. If you Google these type of things like litigation finance or the PCP claims or the latest big actions like Uber or Volkswagen, you'll see the interest and the growth in the market and how many people are now kind of looking into that. I mean, we've got a couple of the big players in our industry that have listed on public markets. There's definitely more awareness in the industry by retail and institutional investors. They do focus on the bigger cases, which obviously have the kind of binary outcomes that we mentioned. But as an investor, it depends on what you want. Do you want the kind of more predictable returns, stable returns? Then what we do is definitely more something that you should look at. If you want the more kind of VC type equity returns, then the bigger cases are for you.
All right, great. You're obviously a smart person and probably, cover a lot of content. We love to always learn new stuff. What is it that like to watch, listen to, read? What keeps you informed? What are those secret nuggets that you get to look at every day or week or month? Share some of those content tidbits that you like to,
Yeah, I definitely prefer to read than listen. I think I'm more of a visual person. I find it a lot easier to understand things, especially complex when I'm reading. Um, I do love a kind of quick, straight to the point newsletter. I don't always have the time I'd love to have to do my deep research into things. So what I kind of try and look for is ones that give me kind of insights that are sharp and actionable that I can pick on. There's one that is called the Private Debt Investor that I think we look into quite a lot for the types of deals that similar to ours. Short Squeeze is one I use quite a lot. I
that's a
read a lot.
newsletter?
Yes, yeah, similar. Again, not only alternatives, public as well. Finimize is another one that I use quite a lot. But I read a lot of books, if I'm totally honest. I
Give
do
us a
love
book or
a
two.
good. I love classics like Warren Buffett classics are definitely up there. But my recent favorite was the one called The Psychology of Money. I don't know if you've heard of it. I think it's a very simple kind of basic book. Nothing in there will blow anybody's mind, but it's such a powerful reminder of how your mindset and your behaviors just matter so much more than spreadsheets sometimes. And it's definitely part of like how to build long-term wealth.
Said from a math degree, so it must be interesting. So the final question, we like to put our people on the spot here, which is give us, we call it 3 years out, a pick for 3 years out, one public markets pick, from the stock markets, and then one private alternative investment. So the more specific with ticker symbols and et cetera, the better. So what would be your 2 picks and why? So feel free to go with your public pick first. What would be your public?
Public pick. It's got to be AI. It's got to be an AI pick. One that I have recently been looking into is called Big Bear. It's a kind of niche in defense and logistics. It's quite small cap, and I would say it's very speculative and volatile at the moment. It's one I'm very closely looking at, and I'd take a bet on.
Why do you like it?
Why do I like it? I've been looking into AI a lot recently, and I think the defense side of things with what's going on in the world at the moment is something to very kind of closely look at. I also think that they've got kind of government-backed contracts, which is always a big positive for me.
Perfect. And then in the private markets world, outside obviously saying we should invest with you, which all of our guests obviously think that's a good idea. What would be a private markets pick, whether it's art, collectibles, private credit, crypto, real estate, a startup, anything that's not public markets?
So cybersecurity is another kind of industry that I'm looking very closely at the moment. I think if you're going private, that's not startup, because if it's startup, it's very specific to the people, I think, and the very core business model that you're looking at. If we're looking at slightly larger private, I'd go with something that's got an IPO anticipated at some point. I'd probably go with something with recurring revenue. I think Arctic Wolf at the moment is a strong one. Managed cybersecurity, kind of typical mid-market.
All right. Do you have any sense of what they're priced at these days?
Big Bear, something like under $5 at the moment. Can't remember exactly.
But I mean, Arctic Wolf, are they, I can't think of the top, are they like 10 billion or 5 billion or 20 billion?
Market size.
Yeah, like their market cap. We'll figure it out. But it's a very interesting pick. We haven't heard Arctic.
Yeah, they're $1 billion company. They're not small.
Right.
And they're definitely, hopefully, planning for an IPO. There's rumors out there.
Okay, perfect. Well, Louisa, we have covered quite a bit. Everything from graduating from uni to starting 5 years later, your amazing firm. You were in the investment club, and that obviously got you started with public markets, but you already were thinking about how to do other stuff. I love the fact that you said that, we don't teach about how to get into alternatives when you're young, so you have to educate yourself and get into it. You like to invest into what you know, and you like to diversify. You're definitely not into the traditional 60-40 old school public markets bonds, but instead you flip it 40% public and 60% into really interesting private investments, whether it's your own startups, other startups, property, etc. It's amazing that you're a serial entrepreneur. You do think that there is a recession looming. So that was great. You do think interest rates have to come down probably by 100 basis points, and we need to get inflation under control. So Fenchurch Legal, super interesting. You've been around since 2020, already $45 million deployed, 20 to 25 million, pounds deployed, 20 to 25 million pounds already returned. Thousands of cases, actually 15 to 16,000 cases, about 3,000 pounds per case, which is super interesting. 80 to 90% success. And you practically like an insurance company because you're pretty much guaranteeing the returns, which is fascinating. Anybody can join from around the world. You can invest in dollars or in euros, $10,000 minimum. And you have different products, whether it's 2 to 3 year lockup, quarterly, or get all your money returned. At the end, 11 to 13%, various ranges. It does sound super interesting. You gave us a bunch of great content. And of course, the psychology of money was your pick for the book. And you had your amazing picks for 3 years out. Big Bear, which is an AI company, and then Arctic Wolf, which is a major cybersecurity company. Louisa, thank you very much.
Thank you very much.
Smart Humans with Slava Rubin is a podcast brought to you by the team at Vincent. Any data, text, or other content in this podcast is provided as general market information and not as investment advice. Past performance is not necessarily an indicator of future results. For more information on alternative investing, check out Vincent at www.withvincent.com.